In this lesson, we're going to be talking about level 3 understanding the master pattern, and this is the advanced theory of the master pattern. So this is the highest understanding we're going to go to. There is more to this that you could go to, but in reality, I find that the more you get detailed in the master pattern, sometimes you lose sight of the basics. So I don't recommend going too much deeper than this, because you want to still, at the end of the day, you want to know how the watch works, but you really still also want to stay in tune with the basics. So at the end of the day, the whole thing, the master pattern, is designed to take a bunch of intricate concepts of how the market works and give you a simple pattern to use to actually execute trades to get in and out of the market effectively. So we don't want to take away from that with too much complexity. So that all being said, let's go ahead and get into the lesson here. So what specific strategies can you use the master pattern to create? So we're going to go through 4 examples. We have intracycle communication, which is one. The next one is spotting efficient versus inefficient markets. Order block projections, we're going to go into. It's a more advanced concept. And the multi-leg expansion, which is another characteristic of the master pattern, the way that it plays out and the methodology overall. So why is this important to understand, these 4 different examples of strategies or components of the master pattern? When you understand how the master pattern works as a whole, you can take certain characteristics of that pattern to form your own specific strategies and approaches to trading. So basically, you can look at a certain way that the pattern plays out, and you can harness one aspect of that repeatably to exploit that one thing for profit. So there's a number of things here that we're going to go over that would help you do that. Okay, so first one we're going to talk about is the multi-leg expansion pattern. So the multi-leg expansion happens when there hasn't been enough accumulation of inventory to fuel the bank's distribution or trend phase. This type of price action also signals mixed sentiment on the higher time frame. So meaning that the banks really don't know what they want to do yet. The banks are the ones that push the higher time frames with their agenda. So if you're getting a lot of what we'll talk about as multi-leg expansion, that means that they're just not ready yet. And therefore, every breakout ends up coming and trading back into the general range area. So the market will remain in a multi-leg expansion until price has clearly gone through the trend phase and established a new contraction and expansion point at higher or lower prices, meaning we're going to see the 3 market phases totally complete. Multi-leg expansions can have up to 9 or more legs in extreme circumstances. So let's take a look at what this all looks like. So we start with fair market value, as always, with the 3 market phases. This is what a multi-leg expansion looks like. It looks like price, if you picture a funnel, we all see it like a funnel kind of like this, right? Well, you could think of that, but going sideways. That's what the multi-leg expansion looks like, just like this. And you notice that we have the numbers coming in. We have numbers 1 and 2. Those numbers 1 and 2 are very important because, and if you're looking at ATS software, those numbers 1 and 2 are what give us a fair market value line in ATS software, or an expansion line, we'll call it. Why is that? Well, we have price contraction. Contraction happens all the time. But what gives weight to that contraction area is the multi-leg expansion. And we know that we're in a multi-leg expansion when we have that first swing low or swing high and swing low point. This could also be reversed. That 1 could come out the bottom and 2 could be at the top. What we're looking for is that the high of the box gets taken out and the low right after that, or the low and then the high. So that gives us our first 1 and 2 expansion leg. That's really what we're looking for. When you have that first 2 expansion legs that happen after that fair value area, you now know that you're in a confirmed multi-leg expansion, and you could then expect, am I going to get 3? Am I going to get 4? Am I going to get 5? Am I going to get 6? And so on. I've seen these have 8, 9, 10 expansion legs. Typically, it's going to be rare you're going to get that many. Most of them are going to be in the 3, 4, 5 range, but they can go up. So the key of understanding the multi-leg expansion, when we apply this to, say, the basic strategy, meaning that we have price action that is happening like this, like we see on the example, apply, let's say, a short directional bias to this pattern. When you have 1 and 2, when you get to number 3 at the top of the pattern, then if you have a short directional bias on, let's say, a higher time frame, let's say this is a 30-minute chart that you see this on, and you have a directional bias of, let's say, a daily. When you get to number 3 on this pattern, you're looking to short above value and take it down to number 4 and see if number 4 isn't just going into the distribution phase. Same thing with number 5. You're looking to trade up above the high of number 3, go up to number 5, and then trade down into what is number 6 at this moment. So the multi-leg expansion is you're working these expansion legs in the directional bias. And if you understand the master pattern, that the multi-leg expansion, these sometimes we'll call them legs of manipulation, that's a characteristic of it, you understand how to play this pattern in a predictable way, and that will get you a safe entry into trend. Now, what you don't want to do with this pattern is get caught trading 2 to 3 and then 3 to 4 and then 4 to 5. You don't want to play it both ways. I know it's tempting to do it, especially when you see things clearly happening. But the real key at the end of the day is applying this pattern, understanding you get these multi-leg expansions, but applying it to the directional bias. That is super, super important. Because then if your directional bias is short, you're hitting 1, you're hitting 3, you're hitting 5. If your directional bias is long, you're hitting 2, you're hitting 4, you're hitting 6. And you're taking it only in that direction, and you're trying to get through fair market value. So it's a very simple, powerful concept, but if you don't keep it simple, then it could work against you. Now, what other traders see this as is they're looking at this and they're getting caught in what we call breakout trading. They're seeing the number 2, they're going short. Number 3, they're going long. Number 4, they're going short. Number 5, they're going long. Number 6, they're going short. This is, sometimes we'll call this the whipsaw or the widowmaker pattern, right? This is what destroys traders. So what we're doing with a multi-leg expansion, the way you could think of this, the reason why we call this master pattern, we have fair market value, contraction. This is the expansion phase. This is a type of expansion, by the way. So just clear that up. And then we go into the trend phase, which is eventually where we move from this fair market value and establish a new fair market value at higher or lower prices. That would be the completion of 3 market phases. But the reason that we look at this and we want to understand that we can't have these multiple legs is that, number 1, this is what destroys traders. This right here, if you get caught up trading this wrong and chasing these breakouts, you can lose a lot of money very quickly. But if we start from this pattern, understanding what this pattern's about, and when we see it, we understand, okay, this is where the majority are going to lose a lot of money, but we use the pattern to flip the script and trade against those traders, that's where it becomes very powerful. By understanding this pattern, you're basically taking the biggest losing situation for most traders and using it in your favor. So if you could make money in this environment, then the rest becomes pretty easy. And this is where all of our entries and our understanding start, is from understanding that this is playing out, is the multi-leg expansion and what the characteristics are of this type of price activity. So very, very important to understand this. Because not understanding it, if you don't understand it, you're typically going to fall victim to it and doing the wrong thing at those numbers. Again, going short at 2, long at 3, short at 4, long at 5, short at 6. You're going to be getting stopped out at the wrong places on each side of this pattern, and it's going to be very painful. So understand that there is a multi-leg expansion that happens. We don't know how many expansion legs are going to happen. But when you get the first 1 and 2, then you're going to look for, am I going to get 3? Am I going to get 4? Am I going to get 5? So on and so forth. And then you will be able to treat it accordingly. And the main goal is to not fall victim to the whipsaw action, to actually use it to enter the market in the directional bias. And following the directional bias is the absolute key to not getting destroyed with this pattern and actually using it to trade effectively. Okay, the next one is intracycle communication. So what are we talking about here? We're talking about cycles within cycles. Okay, we just studied the multi-leg expansion. What do we see right here? We have a master pattern origination point, fair market value with that box with the green outline. Then we have what? 1, 2, 3, 4, 5, 6. Same pattern we just went over. This is the multi-leg expansion, that funneling out action. So if we're looking at this, we know after 1 and 2 that we're in potentially a multi-leg expansion. So we know that funneling out action is happening. How many legs? We're not sure. But we know that this is the general characteristics of the market that we're in. It's defined after 1 and 2, especially as we get 3, as we get 4. So when you expect funneling out action, then inside this pattern, there are other miniature patterns happening. So if you understand what's happening on the higher time frame scale, then you could make minor predictions inside that pattern. So as you see in here, we have these minor contractions that are happening with their own expansions. So as we go through, we see the bottom red box. This expansion with 1 and 2, particularly where that red 2 is below, we're talking the first red box that you see in the chart. As that's happening, yes, it is a multi-leg expansion, but what's the overall context that it's happening in? The overall context is that it is undervalued in a much bigger multi-leg expansion. The green 1, 2, 3. This is part of the 4th leg of the bigger cycle. And so if we're expecting that green number 4 is going to go up and turn into expansion leg 5, then we could predict this minor expansion, this first red box, to potentially break out in that direction in fulfillment of the bigger cycle. So there's always cycles within cycles within cycles. So this is where we talk about looking at the higher time frame situation, the higher time frame weather sometimes we'll talk about. Where is that in its cycle? Because if we could predict likely where the higher time frame is going to go, then we can predict the cycles that are happening within that and the outcome of those, and that helps us just kind of get in the money on trades. Because we have a way to predict likely where it's headed. So anyway, I don't want to spend too much time on this, but that's really what the deal is here. Is if you could spot where you're at in the overall cycle, then when you get cycles within that, the higher cycles, time frame cycles, always the one that's the most in control. So these other cycles that are on lower time frames they're going to have the same characteristics, but the fulfillment of those cycles is ultimately predictively going to be in fulfillment of the bigger, higher time frame cycle. So as you work those smaller cycles, you could do that, and that'll affect your bias to how you want to trade those smaller cycles. So that is intracycle communication. Doesn't need to really be much more than that. Something to study. This could get very detailed. So you want to know about this concept, but again, you don't want to get so lost in a concept like this that you lose sight of basics. If you follow the basic strategy, which is higher time frame trend, clearly defined, trading overvalued or undervalued in that trend, you will naturally line up with these principles. So you don't need to know every little detail to be successful with the method. This is just so you know what's going on, right? Okay, the other thing that you can use the pattern is to identify efficient versus inefficient markets. So an efficient market results in a tight confined range. This is what results in our establishing fair market value. So price funnels down. Price either funneling out or it's funneling down. So you can think of it like lungs breathing. It's like you have contracting lungs and then expanding lungs. The market is always breathing, contracting, expanding all the time. And that leads to the 3 market phases. When you get the big expansion leading to the distribution, that's the trend phase. But other than that, contraction, expansion, contraction, expansion. So this is an efficient market. The reason why this is efficient is because you have a lot of willing buyers and sellers at this price. That's why price becomes trapped. So this is, market makers love this. They love this territory because they're able to collect a lot of their main revenue source, which is spread commission. That's their bread and butter. That's how they make their predictable money, right? They make their big money in proprietary trading outside of that. But this is a high spread environment. So when we go into expansion, second phase of the three market phases, multi-leg expansion, however it plays out, that's where we go into an inefficient market. The reason why we know it's inefficient is because the price is starting to travel. It's starting to move around, meaning that there isn't as many willing buyers and sellers at that contracted price anymore. So as price opens up, you're getting the gap action, you're getting bigger expansion legs, and that's where as traders we want inefficient markets. Your entire job as a trader is to exploit and spot inefficiencies and take advantage of those. So you can see by understanding the master pattern and the advanced theory behind it, you know when you're going into an efficient market, because the more efficient the market is, the less edge you can have, the less money to be made. When you go into the expansion, you know that you're going into a inefficient market, and now you could start to exploit this bigger range that is now opening up, and that is where you actually get some sustained moves away from value, ideally, and hopefully find that distribution phase. Now, you can still do well trading expansion legs and never finding the distribution phase. And that's where you want to start, is you want to start your entries in the expansion with the expectation that you're going to get into the distribution phase at some point. But nobody knows. I don't know. Nobody knows when the distribution is happening. So the goal is to get well-placed or safe trade placement in trend according to expansion legs, so that you can get in the money to see if there's an opportunity that you land yourself in the distribution. It's all just defense, trying to protect your capital and bake in the market and wait for a good outcome to happen in the predicted direction of the higher time frame money. So again, going into an efficient market, expansion opens up into inefficient markets, as we see here. So pretty simple concept, but an important one to understand what's happening behind the scenes there. So looking at the higher time frame, you can see this represented in candles. A lot of people will call this a fair value gap. Either way, however you want to call it, it's efficient market going to inefficient market, going back to efficient market. When you get a lot of candles that are overlapping each other, stacking in front of each other, that is representative of an efficient market in those candles. When you get candles that have separation with one gap in the middle, like we see right here on our example, then that is going into an inefficient market. The reason we know it's inefficient is because price is starting to travel, meaning there is not enough willing buyers and sellers at that level to keep price trading in that range or trapped inside those levels. So let's keep going. Next one, order block projections. So we use order block projections to set price extensions and typically profit projections. Let's cover this right now. Isn't Fibonacci the same thing? No. Order block heights are set by the banks themselves. We are setting our expectations based on their organization of market framework and range size. So an example is if the banks allow an expansion range to grow to 45 pips in total height, then we can reasonably expect that the trend phase will be at least 45 pips from the confirmed high or low. So in our example, you can see we have the typical contraction, multi-leg expansion. So as we go through, you can see that we have the swing low and the swing high point on the last part here. As we come through that swing high point, to calculate an order block projection, you would measure from the swing high liquidity point to the lowest point, confirmed point of the current multi-leg expansion. You would take that exact size from, in this case, low to high, and project 100% up of that size. Now, the reason it's important to take that size is because the market makers are setting the range. They set it from the contraction, they set it through the multi-leg expansion. So that 100% projection based on the expansion range size is their exact measurement, because it is the limits that they have allowed the expansion to move within. So this is not, we could set Fibonacci's and different things at other levels in here, but we're specifically looking at the expansion size of the range. From, you think of the multi-leg expansion from 1 to 2 to 3 to 4. Every time we get a new number, 4 or 5, the expansion range is widening. Every time you get a break out of the other side of the range, you get a new order block projection. So you could take the exact confirmed range when you come through the swing high, the previous swing high or swing low point, and project that 100%. And you can be confident that that's going to be a accurate projection, because again, it is set on the allowances that the market makers and the banks themselves have allowed the market to expand so far. It's based on that exact measurement. So that's why they're very accurate. Okay, so keep going here. Using order block projections to navigate the trend. Let's look at an example. So right here we have a weekly chart. Inefficiencies confirmed to the downside. ATS trend is confirming short. As we go here, we have a 1 hour chart that would be trading up above value right here. So you could see that we have come through the swing high liquidity point represented by the red X. If we project out, you measure down to the confirmed swing low point of this cycle, and then you measure to the swing high liquidity that we came through on the red X. You take 100% of that from the exact low to the liquidity and project upward. That is your order block projection to the upside. Now, keep in mind, the higher time frame money is going down in this situation. The weekly is heading down, and this is a 1 hour chart. So from a basic strategy standpoint, we are now overvalued in a market that is declining. So let's keep that in mind as we keep going through this example here. So as the market trades up, what happens? We have a failed attempt to trade through the high order block projection, which shows a lack of bullish institutional intent. Keep in mind, they are setting the range. They are setting the projection. If the market makers fail to even reach 100% of the current range size, is that really, could we really say that that's a strong breakout, that that's a strong distribution that's happening? No. And because the higher time frame is short, we had a predetermined outcome to the current expansion to play out to the short side. So we already have that. Does it guarantee that it's not going to be a reversal or it's going to go up? No. But from a probability standpoint, we would expect there to not be much interest in the upside. In fact, any traders that are trading the upside, we want to trade with them because probability is not in their favor. So the fact that we can't even go 100% of the range size to the upside shows weakness in the market. It shows that it still wants to go short. So what happens here, trading through the expansion cycle low confirms a new range size and order block projection. So as we come through the swing low liquidity on the bottom, we now measure to the very tippity top of the failed upside move from the swing low liquidity. 100% of that gets projected to the downside. That is the new range size. So you can see as the multi-leg expansion widens out, you're getting bigger and bigger order block projections. It's getting wider and wider. And it's also forecasting a bigger and bigger move when we finally go into the distribution. You can count on the fact that eventually you will go a minimum of 100% of the range size. You will hit one of these order block projections, usually the biggest one. You will hit the biggest one eventually. So right now, let's say that that is 100 pips from that swing low liquidity to that low order block projection. what does that do for our strategy and our forecasting? We know that in some amount of time, there is 100 pip opportunity in this market. It may be either to the upside, because what also do we have? We have 100 pips coming across the range to the upside as well. So let's say that we had a long directional bias on this. You have 100 pips minimum coming to the swing high liquidity. Plus, if we went up, you would get a new order block projection that would be more than 100 pips. So what we're doing is we know that we're making a forecast of volatility to the upside or downside from this exact level of swing low liquidity that it's at right now. So we have a minimum of 100 pips, let's say, to the downside, and we have a minimum, if it goes up, of potentially 200 pips to the upside. But let's say we're already in, you sold at the last failed attempt to go long because the trend is short. So what happens next? Well, the market ranges out, has noise like markets do, but eventually we trade down through that 100% order block projection to the short side. So you have, from a mathematical standpoint, if you traded up on the failed attempt to go long, you came through swing low liquidity, predictably we're looking for the market to go short because the weekly's already short. You can mathematically count on what you can expect to the short side based off the order block projection. It is a conservative profit target to trade 100% of the range size that is established by the market makers. Again, this is why it's better than Fibonacci, because it's set off of the multi-leg expansion. And that is their playground. That's the bank's playground. They set that exact high. They set the exact lows. You got to bet on the fact that their distribution is got to go at least 100% of the confirmed range size. And usually it'll go many times the confirmed range size. So from a conservative forecast point of view, you can use these order block projections to project very conservative profit targets from the bank standpoint, but also mathematically set your risk to reward to a pretty favorable situation in your expectation, and you could pretty much be dead on a lot of times. All the noise that happened through here, again, we're not looking at traditional indicators. All the noise that happened on the way down to that lower order block projection, if you got tangled up in that, yeah, you could be trading long, short, especially if you're using like moving averages or whatever. We can get lost in that. But if you stay grounded to the previous expansion phase and you understand the order block projection associated with that expansion phase, then mathematically you already have this in your head and you hit that outcome. Sooner or later it will. In this case, it was a little while later, but you have that exact profit target that you know you're going to close at in trend. And that way you have a predetermined profit baked in to this whole situation that you eventually hit. So it gives you a very exact way to plan out your trades. All right, so what's the takeaway from this lesson? The master pattern framework is based on the root cause of market movement. Because of this, you can create all kinds of strategies and approaches from this framework. What strategy will you use the master pattern to create for yourself? You've had now a number of things to understand this on a deeper level. You can, again, take these more advanced concepts and use them in your own trading to forecast profits, to understand market movement, understand activity, understand if you're in a multi-leg expansion, understand the intercycle communication to help you forecast which way the markets are likely to go. All these little details, understanding them on a little bit deeper level, give you just a little bit more edge as you learn the master pattern to compete against the other traders and get the results that you want. So, do you guys have any questions regarding what we're talking about here?
Hi, Wade. Okay, thanks for the lesson. One question that I have is how far back should we go to look at the major master pattern when we're dealing with the minor master patterns that are taking place within it? Like, do you have like a rule of thumb going back maybe 3 boxes or 4 boxes? Or you just elaborate on that?
It really just depends on what you're using as your higher time frame and kind of the situation. I would say that you can go back is if you don't clearly see a distribution has happened, then you're still dealing in that multi-leg expansion, and that could be 3, 4, 5, 6 boxes back pretty easily, especially if you've been in an overall ranging market for, let's say, days or weeks. Then you're going to have a lot of relevant points there that are all interacting with each other. So the more, let's say, kind of like clouded the market gets with different contraction points, you want to go reference back farther and farther to the main one that happened after the last major distribution phase. Go find that one, because that very first one typically sets the new overall range, and then you could work from that one. But it is, every situation is slightly different. Ideally, what you want to look for too is one with even distribution on both sides. So meaning the expansion legs. Sometimes the expansion legs can be kind of weighted to one side up or down of the main pattern you're dealing with. But if you find a contraction in that, let's say, cluster of boxes, find one where the swing highs and swing lows are relatively the same size, because then you're kind of in the middle of the funnel for that reference point. That's usually what I find is the one that has the most even distribution will definitely help. So does that kind of answer your question?
Sure. Yeah. Thank you.
Thank you. Any other questions? All right, Rick, got a question. I'll mute you real quick. Go for it.
Hey, Wade.
Hi.
Hi. Okay, so my question was more around how to identify distribution. And this stems from, the previously with Shane, when we would talk about price settling and having to move in a sustained direction. So I'm just thinking, for purposes of this lesson, when you talk about if you haven't seen that price has been distributed, how would you identify that with just your naked eye looking at it?
Yeah, distribution's always going to be more difficult to identify because it very easily could go from a leg of expansion or manipulation into boom, it just breaks out and then it goes, and then here, obviously you're in trend. So in reality, the only way that we're really going to be able to see distribution for the most part is after the fact. There's not really a way to understand when you could, like, let's just put it this way. You can't necessarily be like, I'm only going to trade when the higher time frame is in distribution. Sometimes it is obvious, like if it's just in a massive trend. But for the most part, a lot of times it's not going to be obvious. So the only way we can really do it, and that's the whole point of the basic strategy, is to get positioned in expectation of a distribution based off the higher time frame. Or can we guarantee that the distribution is going to be in the higher time frame direction? No, but the probability, if the market is flowing one way for weeks, then every contraction we get on the lower time frame, we come to that contraction with the preconceived expectation that the distribution is going to be in the direction of the higher time frame. And so that's where we get positioned above or below value, build positions, and do what we need to do to really just get positioned for the distribution, because nobody knows when it's going to happen, how fast it's going to happen. We use order block projections and things like that to forecast how big it's going to be, all that. But yeah, there's not really a set characteristic to say clearly, like, I am for sure in distribution and there's going to be a continuing movement. All we could do is get a strong entry from a risk management point of view and have a preconceived expectation of where the distribution is going to present itself and already be in the market. And once we get through value, you guys know, like, we're just trying to get from entry to value. That little space is just trying to get us in the money so that we have some options. At that point, sometimes waiting for the distribution is a little bit of a roll of the dice, But at least when you roll the dice, you're already on the house's money. That's the goal. We're just trying to be in profit so that if you decide you want to roll the dice and see if it is a big distribution that you're going to be in, at least you're doing it on the house's money and not your own. So hopefully that answers your question. Good, Rick. Marion, I see you got a question. I'm going to go ahead and unmute you. Go for it.
Hey guys. Yes, begin a question again. Related to the same thing. So, is it possible that the expansion of the trend phase on this three market phases, is it possible this phase could be smaller than the actual legs of the expansion?
Yeah. Yeah. The only thing at the end of the day, if we're looking at from a completion standpoint of the three market phases, we have a contraction, we have a box, we have an expansion, a leaving the box, and then we have a distribution from higher to lower prices or lower to higher prices. So basically, if you think about it, let's say that we have a breakout, we have a contraction, we have an expansion, and then it breaks out past the last swing high point to the upside. If we have a box that it gets established above the last swing high point that we broke out above, that can be looked at as a completion of the three market phases, is establishing a new contraction above the last established swing high or swing low point to the upside or downside. And that's it. Those are the three puzzle pieces that we look for repeatably to happen. So yeah, absolutely. To answer the question, simplified, yes, the fulfillment of the distribution can be just minorly past the last swing high or swing low point that you've just broken out, and then it's done. So hopefully that answers your question. Joel, I see you got a question. I'm going to go ahead and unmute you.
Hello, Wade. Good afternoon, my time.
Hey, Joel.
I'm just joining. I don't know. We didn't have the number webinar because I realized I just had to connect to XFAP and I realized it's already on. I had a question, so maybe it's already asked, but let me just ask it.
Sure.
In relation to time frame pairing, I always pair the 5 minute and the 4 hour, but I realize that sometimes the 4 hour changes a lot. Is it okay to pair the 5 minutes and the daily?
Yeah, we just got this question into support yesterday.
Okay, sorry.
No. It was good because I've just answered it.
Okay.
So it's in
Just
top
joining.
top
I
of
don't know
mind.
what happened. Just joining the webinar now. I don't know if the time changes or change. I don't know what, but that was the question I had in mind. So
Yeah, no worries. So here's the thing: you could trade the 5 minute into the daily, no problem. But you know, here's what it's pretty far apart. We want to have separation between our entry and our higher time frames, so that because we want the stability, but you are getting kind of, really separated. So, but I understand what you're saying. The 4 hour, especially if you get in like a whippy environment, it could go up and down, and it could get kind of confusing. So, the short answer is yes, you can trade into the daily, but also too, you can experience much bigger pullbacks on the 5 minute based on the daily direction, where it could get you into situations where you're at a bigger drawdown and you're kind of waiting to see, is a daily going to change direction? But you could easily go down 30, 40 pips waiting for the daily to change direction. So what I would recommend doing, if you're having a problem with a 4 hour, the best of both worlds, rather than just having the 5 minute trade in the daily alone, trade the 5 minute and the 4 hour, but only trade when the 4 hour is in alignment with the daily. And so that's typically the best of both worlds, because then you're still using the 4 hour for your risk management, but you have a much higher probability when the 4 hours in momentum with the daily, they're confirmed in the same direction, that you can capitalize on the daily's moves. So, but if you want to be open to a bigger drawdown, you can trade the 5 minute into the daily, but just understand that you're going to have, 30, 40 pip drawdowns sometimes, waiting for the 5 minute to come around, because the 5 minute might give you some framework or show you, like, it might be looking like it's going into a turn, and then you pull the trade there, and then next thing you know, it's going into a much bigger drawdown. And in reality, if you were trading the 15 or the 30 minute into the daily, you wouldn't have seen that framework, and it wouldn't have given you that minor little signal to take action on, just because of those time frames are a little bit higher and better associated with the daily. So that would be my advice for that. But if you approach it and you're trading small enough, then you could build a nice position on the 5 minute into the daily. You just have to be prepared for the drawdown, because you will get a little bit of early signals, and then next thing you know, it's in a bigger pullback, going, more in line with like a 30 minute, 15 minute entry. So does that make sense?
Yeah. Yeah, no, it makes sense. I noticed you have to mediate it with the 4 hours. Because I've been testing it. You have to mediate it with the 4 hours to really be at a good position. Like you said, the best of both worlds. If you stick only to the daily, you can be in a peak drawdown. You're right.
Yeah, but I know what you're saying, because sometimes the 4 hour gets whippy, and you're like, if I just would have stayed in the direction of the day, I would have been good. Because the opposite of that too is that if the 4 hour, let's say the daily's long and the 4 hours short, then you want to, sometimes the entry would be the 4 hour coming back around in alignment with the daily. And then now by the time the 4 hours aligned, then 30, 40 pips have already gone by that you could have had if you were just looking at the daily direction. So I get it.
You get it.
I get it. So, that may be, if you really want to trade in the daily, it's a little more advanced, but you may want to experiment with a 5 minute and a 30 minute into the daily. You could also do that. And so you're using the 5 minute in conjunction with the 30 minute for your entry. So it's kind of like two entry time frames. But sometimes you get lost in that. And I don't want you to get in a situation where you're over trading. But if you're pretty discerning and, obviously you have some time in this. So that may be something that you could look at and kind of use the 30 minute to qualify your 5 minute entry, and maybe sometimes you won't be too early. So just something you could play around with. But at the end of the day, you really can't go wrong with just letting the 4 hour realign. I know you're going to miss some pips on the rotation back in, but again, going back to if you missed the last webinar, you can watch the replay when I put it up. But we're talking about qualifying customers. We would rather, if we look at every trade opportunity as a customer, then we want to look at that as what customers do we want to engage with? Do you want to engage with high quality customers where they're going to have the most value, you can make the most money, or do you want to engage with low quality customers? And so it would be better to interact with customers that you can predictably make the most money from. So if you can better and more safely forecast 10 or 15 or 20 pips when the 4 hour and the daily is already aligned, that may be more valuable to you than sometimes getting the bigger move, but having the possibility of the daily reversing on you and taking a bigger loss. So at the end of the day, repeatably predicting the market and capturing smaller amounts of movement could be more powerful than just being in for every big move. So it's just something you got to kind of weigh out and decide what you want to do. There's no right or wrong to it. Just do what you are more effective at, is what I would say. All right, let's go. I don't know if you still got another question, Rick, but let me go ahead and I'll unmute you, and you can go for
it. Hi, sorry, Wade. I think you actually answered some of the question that I had in the previous one, because I was actually, that's actually some of my frustration as well sometimes, where the 4 hour that rotate in and out makes you feel like you've actually missed out? And I was going to ask you, would you get away with ignoring the 4 hour if trading, say, the 15-minute or the 30-minute into the daily? Could you absolutely ignore the 4 hour?
Yeah. Yeah, you could, with the 15 or the 30-minute, because they're higher enough time frames, you're getting a better correlation at that point. There's a good amount of separation still, but you're gonna it's like trading like if you're gonna trade the 1 minute into the 4 hour, the 1 minute can sucker you in to so many different opportunities, and so we want to try to eliminate that as much as possible. So going and trading the 15-minute or the 30-minute is just going to take away some of that extra opportunity that may seem like opportunity, and it's just a better correlation. So yeah, absolutely. I think the best time frame pairing, really for almost everything, and I hesitate to say this because I don't want everyone that watches this to latch onto this, but if someone told me you can only trade these time frames for the rest of your life, the next ones that you pick, I would pick a 30-minute and a daily chart personally, because you can almost scalp with a 30-minute chart. Like you could take 20s and 30s off of a 30-minute chart, but 30-minute you can also ride the 30-minute through multiple days sometimes, and it's relatively stable enough to manage through a multi-day trade. So I feel like the 30-minute, if I had, they're like, this is it. You get these two time frames and that's it. 30-minute and a daily will cover your basis to do either multi-day swings or some scalping potentially. I think it's the best of all worlds.